So I'm here today with Pete. Many of you know him as Wheelie or WheelieDealer from his blog and his extensive tweets. And what strikes me about Pete is his capacity to be there for other people. And this was really typified in his tweet that he posted just before Christmas, which I'm going to read to you. On a very serious note, if anyone out there is stressed and worried and feels like it's all going wrong and they're not in control, etc., then email me or whatever, and I'm happy to help. I often chat with people who need reassurance, and feel free to shout. And I wasn't alone in being moved by that. I think there was 189 likes and something like 30 retweets, which was quite extraordinary. What was the catalyst in sending that tweet?
Yeah, it was a time of year thing. I mean, what you tend to find on Twitter and whatever is when you get to year end, you get all these people putting out tweets. Oh, I've made 50% this year. Oh, I've made 30% this year. Oh, I've made 70%. You know, all these really glowing tweets about the amazing performance they've had. And I sort of felt that I know there will be people out there who haven't necessarily even made money this year, you know, last year. And there'll be others who've perhaps only made 5%, you know, and they're going to feel a little bit sort of deflated. And I thought, well, you know, this is a bit silly really, because it's not really good to compare yourself in that way, because everyone has a different approach and a different strategy and different numbers of holdings. They buy different types of stocks and they have different requirements of returns. And, you know, some people want to sleep safely at night. Other people love living on the edge and high frequency trading and, you know, being at it all the time. And so there's so many differences. And I just thought, well, you know, it's not really that meaningful. And I thought there would be a lot of people, particularly newer people, who are going to be like feeling, you know, pretty upset about it all.
So when you write a tweet like that one at Christmas, does everyone contact you with investing problems? Or it seemed broad spread, so I sort of thought...
Yeah, no, it was really, you know, I think the people who follow me tend to be investing. Yeah. So the responses I got really were around investing. You know, I got several responses. It was, and some were quite eye-opening. It's you know, as we said earlier, you know, most of us had a pretty good year last year. Sorry, most of us, a lot of us had a good year last year. But there were people who lost a lot of money last year. You know, I had people contact me who'd lost 40, 50% last year. You know, and it's, yeah, so it's great that I can help those people.
And are you looking to help them emotionally or with practical advice?
Yeah, I think it depends. I think obviously emotions is a key part of it. That, you know, you cannot escape that. But I think for most people, the most common error that everybody makes is, you know, they're buying these AIM resource junk kind of stocks. And, you know, a lot of people buy those stocks and do very well in them. Yeah. But it tends to be, the way to do it is to buy it when it's low. When it spikes up, you sell it. Yeah. Problem people make is they think, oh, I'm going to buy this oil share, you know, this explorer for oil that's actually got no oil. They're just looking for oil. You know, I'm going to buy this and I'm going to become a multi-millionaire. Well, it just doesn't work like that. You know, you've got to sell the spike. When it spikes up, sell it. And then when it drops back, buy it again and sell the spike again if that's what you want to do. I can't be doing with it. I'm just, you know, so I'd rather be here this afternoon, you know, chatting to you than sitting in front of a screen watching all the numbers, and it's all too stressful. I just can't be doing with it. It's getting this work-life balance thing where I have my Twitter, WheelieDealer website life, and I have my own investing activities. Then I have my own life, you know, and it's getting all these things in balance. And the last thing, I think there's a lot of people who burn their lives. Their lives are just slipping away like a sands of time as they're sat in front of a screen going, you know, getting all stressed. And I just can't be doing with that.
So the majority of people that you mentor, if that's the best way to express it, are they coming to you because they've lost a lot of money or because they're too scared to invest? Or
I think it's a mix. I think, you know, a lot of people I help are new people, you know, literally from scratch. They've never invested before.
And how do they find you?
Well, quite a few find me through Twitter, which is quite amazing. And other people sort of say, oh, have a chat with Wheelie, he might better help, And so a lot of the time it's people who've never done anything investing before, and they're like, well, I've got this money, how do I go about starting? What do I buy? How many shares should I buy? This kind of thing. And then, as you say, there's the other type, which are people who've been doing it for some time, had periods of success, but they haven't been able to get that consistency. And that's really what's key. It's all right making 60% one year, but if you're losing 40% the next, you're not really getting anywhere. And it's getting that steady consistency that's really important. So a lot of time it's like helping people who are already in the game. And as we were saying before, the emotional side is very much part of that. The thing that stands out to me there is it's when there's tough times that the emotion thing really comes into it. And it's noticeable how on Twitter and stuff, people go quiet. When the markets are bad and it's a difficult time, Twitter just goes so quiet, And then when it's all booming and everyone's doing that, it's like, oh yeah, we're all tweeting away and everyone's happy. So there's a real emotional thing around that. And a lot of time, there's a lot of, sort of calming people's nerves and saying, stick with it. You got a good portfolio, just ride it out. It's that kind of thing.
And you've talked about the guys that are buying the resources stock that are very volatile. What are and the market volatility? What are the other key issues that you're helping people with?
Well, as I say, I think number one problem is the type of stocks people buy. I think most people who are losing money could almost fix the problem overnight by just stopping buying that sort of speculative, high-risk AIM stock. If they just went to more the quality end and they could buy, there's loads of stocks on AIM that are actually real quality stocks that pay good dividends, good value, and their businesses are growing over time. And there's so many great ones. And then there's things in the FTSE 250 and even things in the FTSE 100, that are worth buying. So it's getting that, it's having that sort of portfolio approach. The biggest thing probably apart from that is matching how you tackle the stock markets with your lifestyle and what returns you want and that kind of thing. So it's like you've got a spectrum. So you've got like at one end of the spectrum, you've got like tracker funds. So somebody who has no time, has very little interest, can't really do much of it. They can just buy a tracker fund and they just don't do anything. That is it. It's totally passive. You just don't do anything. And then obviously you've got like unit trusts and you've got investment trusts which are a bit more advanced, and you've got ETFs, exchange traded funds. And all this is really sort of variations of a fairly passive approach where you don't need to put much effort in. It doesn't take a lot of hours to do. And really you're just sitting on it. You buy it and you sit on it. And then you sort of move up the scale and you've got like, people who just buy big FTSE 100 stocks and they're just looking for the income. They're like an income portfolio where they're looking for 4 or 5% a year from the dividends. And they just buy all the, the RDSBs, the GSKs, the AZNs, the big beefy stocks. But again, it's fairly passive. I mean, they're just, they're not really doing much to it. They buy it and it sits there. And then you get more to what we're sort of doing, the more sort of active, where you are buying and selling more often, and you're topping holdings up, you're slicing holdings, you're getting rid of things, you're introducing new stocks, and you're buying across the spectrum. So you're buying AIM stuff and small caps and FTSE 250 and FTSE 100. You're going wherever you think there's opportunity, but as well as having a diversified portfolio. And that's more active, but nowhere near as active as when you move sort of up the scale again and you're going into the sort of more of a trading approach where it could be that you're using spread bets, CFDs, whatever, and you're trading normal shares or whatever, or you're trading indexes, and you're much more hands-on, and you could be position trading where you're sort of like buying a position, holding it for 2 weeks or something for a period of time. And then you get more the day trader who's literally buying and selling by the hour or by the minute, or, you know, they buy something in the morning, they've closed the position by the end of the day, you know, that kind of thing. And that's very, you know, full on. It's about finding which of those approaches is going to fit your lifestyle, fit the time you have available. I mean, the majority of people who invest in whatever probably have full-time jobs, and yet they think they can be a trader. Well, it just doesn't stack up. If you've got a demanding, really hard job, you're not going to be able to sit in front of a screen all day. It's, you know, your boss is going to sort of notice, isn't he? I sort of like developed my approach over a long, long time, many years, but a lot of it was around the fact that I had a full-time job. And it meant that during the day, you know, maybe first thing in the morning, I would get a bit of a chance to look at some RNSs, but I didn't really have much time to look at them properly. And then sort of like around lunchtime or something, I could log on to my sites and just see how my shares were doing. And then perhaps at the end of the day, when the dust is settled in the office and whatever, you could have a quick look, but you really don't have a lot of time. You probably, if you have an hour a day, you're probably done well. And that's how my sort of approach developed. And I've sort of built on that since. And obviously I've got a lot more time I can spend on it now because I'm sort of full time. But I still, don't spend hours and hours and hours and hours on it because I've got other things that take my time that I have to do, So it really is this idea of matching what you're comfortable with the time you have available, with how you invest.
How long do you spend on it now?
Well, yeah, I mean, realistically, I'd probably spend sort of like hour and a half, maybe first thing in the morning on the RNSs. I probably then don't do much in the middle of the morning. And then as we get into lunchtime, I'm then starting to read the Investors Chronicle. And I spend a lot of time reading. And I'll probably read the Investors Chronicle for a couple of hours a day, just looking for all these different companies and whatever, and looking them up on my tablet on SharePad and, looking at some details on whatever. And then sort of like in the evenings, I might be doing, reading a book on investing or something. And then, as I say, 10 o'clock onwards, probably to about 11:30, I'm looking at my charts and just analysing charts. So probably on average day, I am spending probably 4 or 5 hours a day, looking at stuff probably. But then it depends, that's probably a Monday, Tuesday, Wednesday. By Thursday, I'm losing interest. I really am getting jaded by this point. And Friday, I just really, often don't do hardly anything on stocks, but Friday's the pub day, I want to be down the pub chatting with mates about shares, But then on a Saturday, Sunday, I mean, obviously, you've got other social life things that are going on, but quite often, like on a Saturday, I'll be researching something, or I'll be writing a blog about a stock. So I'm actually researching the stock as I write the blog. So yeah, it does take quite a lot of time, but then I've got the time, so it's like I've got a way of working that matches the time I have. And I think it's really important people have that. And it also comes back to returns. It's like, it's no good, sort of thinking, oh yeah, I'm going to make 80% a year. If you're a buy and hold passive investor, it's just not going to happen. You're dreaming. And it's like, if you're a sort of, if you're just buying a global tracker fund, you've probably got to expect 5, 6, 7, 8% a year, that kind of return. That's what you're going to get over time, averaged over time. So you'll have some years where you lose loads of money. But I think the kind of approach I have, I mean, I always say I'm looking for 10% return on my portfolio, over time. I think in reality, I probably get about 12%. But actually, I think I could adjust how I did things, perhaps be a bit more aggressive. I could probably push that up to 15. I think that's probably doable. But then there's people who trade a lot, and people like Robbie Burns, who's just a legend, the naked trader. He claims to make sort of 25, 30% a year. It wouldn't surprise me if he makes more. His returns are absolutely stunning. But of course, then what I do is, I have my sort of like 10% aim on my ISA. But what I do is I leverage that up using spread bets. So I sort of, getting more return added on because of that. That's the logic of it. But I mean, then there are people like, Justin, who does the Vox Markets share play. He's making like 90% a year. I mean, his returns are absolutely incredible. But, he's on these small resources stocks. He's buying them when they're low. They go up. They spike. He sells them. And he's just continually churning shares over. So it's a much more active approach. And it's like I said, if you've got a full-time demanding job, you just can't do that. So there's just no point of buying those kind of shares if you haven't got the time to do the trading.
And how much money do you think people have to have in order to start investing?
Yeah, it's funny. We were having this discussion on tweets yesterday or the day before it was going around. And there's this view, you should have at least £1,000 to put in an individual stock. There's no point buying less. My view really is that, if you've got £1,000, I think probably your best bet is to put 500 quid into one stock, 500 quid into another, with a view that as you get more money, you get another 500, you buy another stock, and you get another 500, you buy another stock, and you gradually build the portfolio. And if one of your earlier ones does really well and you double your money on it or something, you're then able to buy two positions with the money you had from the one, And it's that just gradually building up. I mean, I know someone who started with 200 quid in each share. It's absolutely doable. And my view is you're better to get started. It's like you can have practice accounts, you can have dummy accounts. You don't really learn that way. It's not real. It's like you just get bored with it. I don't know anyone who runs a practice account who's actually be able to consistently run it. Usually after a couple of months, whatever, they're just bored senseless with it. And it's just meaningless.
So you think if you've got £1,000, that's enough to start investing?
I think if you've got £1,000, then, 500 quid in two shares gets you going, but it's got to be with a view that you're going to get more money in future. There's no point, if you've only got £1,000 and that's all you're ever going to have, you buy two shares, it's a pretty risky proposition. But as a sort of get me started, get going, because that's one of the other things is there's a real danger that if you don't get started, you'll just never get going. And you've got to sort of dip your toe in the water and start to get a feel of it. You learn more once you've got money in the game. That's when the real learning comes. You can do all this learning outside of that, but it doesn't mean anything until you've got real skin in the game. Then it hurts.
So with the recent volatility, what's been your advice to people that you talk to?
Yeah, I mean, the main thing with it is you've got to get away from the screen. It's like if you're looking at it all day and seeing all your shares dropping, it just feeds the fear. If you're watching Bloomberg, watching CNBC with, stocks are falling and, it's all terrible and Trump said this and whatever, the world's going to hell, it just feeds your fear. It just gets you more and more stressed. And the approach I take, and it actually has a sneaky side effect which really helps, is that I try to hedge my portfolio. So I've got like a portfolio of stocks, which are obviously long, so I make money if they go up. What I try to do is put some index short positions on so that as the value of my portfolio is falling, the value of my shorts is going up. So there's some sort of offset. Now, I've got in trouble with this in the past because I've tried to do too much short to offset most of the thing, and practically it's very difficult to do. So what I've learned is it's better to do smaller shorts. But the beauty is when you've got a short on, you sort of don't worry so much about the long portfolio that's absolutely crashing around your ankles. Psychologically, you're looking at your short and thinking, my short is doing so well, I'm loving my short. And it really helps the psychology. And then because you're focused on the short, your mind isn't worrying about this other big problem you've got. You focus on the short, as short goes down, you close the short once you think, right, we're pretty much at the nadir now. Then you can psychologically switch across to your long portfolio, which is now starting to rebound, and you think, I'm going to start buying some stuff now. So it really helps with the psychology of managing. That's obviously a bit more advanced than for newbies, But funnily enough, I'm actually in the process of writing a blog of my latest thoughts on how I hedge and stuff, because I've made those errors in the past, and it's all on my website. 2016, I basically hedged too much, and I ended up making no money in 2016 because I hedged away all my gains, which was just absolutely stupid. So I've put a lot of effort into revising that, and I've got a new way of doing things, and I'm actually writing a blog on that now, and hopefully in a few weeks that should appear, which is much more about smaller positions and using strict stop losses with very tight stop losses, and having specific entry points like breakouts and reversal signals and whatever. But yeah, so that psychologically, that really helps to have a short on.
Very interesting.
So,
although it very much depends what the market's doing, because the volatility has increased so much this year compared to last year that your strategy last year would have worked okay this year.
Yeah, I mean, there is an element of that. I think the funny thing this year, which we were in a really weird situation at the start of the year. So it was really the tail end of last year, December and into January. But things just got so overbought. I mean, when you look at relative strength index, the RSI readings, every weekend I do what I call my charts blog. It usually goes out on a Sunday night, very late, so you probably won't see it till Monday morning. I do a thing called a charts blog where I look through loads of index charts and whatever, and I go through some of these. I always use the same technical indicators over and over and over, the same robotic stuff. Which are things like MACD, moving average, convergence, divergence, the RSI readings, relative strength index. I love a thing which is the 13/21 day exponential moving average. 13/21 day EMA. Absolutely love that signal. It's amazing. It's like on the indexes, if it does a golden cross, so it's like the faster one, the shorter time span one crosses the slower one, you tend to find that index will rise for 2 or 3 weeks. And it does it incredibly well. And then when it does the opposite, a death cross, bad news, it then falls. And again, it does it really well. The only time it doesn't work is if you've got something really choppy. But most indexes tend to move in quite nice waves, I find. So that's a fantastic indicator. And the thing the thing that I absolutely adore are just straightforward Japanese candlesticks. They're just, once you get them, they're amazing. They are so predictive. And they're also great because they show you turning points, but they also show you where you can put your stop loss. So that helps you keep really stop losses, because the key when you're doing sort of like index trades is to keep the losses really small. Let the profits run, but keep the losses really tight.
And in terms of cash, have you increased your cash position?
I tend to run almost fully invested all the time. And that's partly because I hedge. One of the advantages of hedging is that I never really feel this great need to have a massive cash pile. Funnily enough, in the last week, I sold a couple of holdings that had done really well. I just trimmed them because, RMG, Royal Mail and KCOM, because they'd just gone up really, really a lot in a short time. And I thought, these things, I'm just going to trim them a bit. But that gave me money to buy some Hostel World, which I've topped up on today. So I've used that money almost straight away. So I always run with very little cash. But like I say, because I tend to hedge, I don't really need the cash, because it's like cash in a way acts as a hedge. But also, once the market has dropped and you're into this sort of recovery phase, obviously if you have cash, you can be buying. But what I tend to be doing there is I use long spread bets, so I go the other way to catch the upside. So yeah, I tend to be pretty fully invested, really.
So with newbies, what are you advising them with the volatility?
Really, the main thing is just don't worry about it. That, you've built up a portfolio. We've worked on it. We've built you a nice portfolio of a good diversified mix of different types of stocks and different strategies and whatever. They're good, solid stocks. Just ride it out. Just watch what happens, monitor the situation, but don't be obsessively just looking at your phone all the time. Oh my God, my shares are falling, and it just gets you worried.
And is that the advice you'd give your wiser self now, the advice you'd give to yourself when you first started and you lost 50% of your money in 2000?
I was terrified. Yeah. And this is the problem. It's like the fear feeds on the fear. Yeah. And there's a really serious point to this. It's like when you get this fearful feeling, you do stupid things. So what you do is, the market's going okay, then it goes into a crash situation, a slump. It goes down really hard. As it goes, you're like, oh, I'm a little bit worried. And then it goes more, you're like, oh, I'm getting really worried. And then more, and it's like, oh my God, I'm getting really worried now. And then when it gets to the bottom, God, I'm terrified, I'm going to sell everything. And you've just sold everything at the bottom. I see it all the time on individual stocks where people, you know, it's like they've held the stock, it's gone down and down and down, and then they sell it at the bottom. You know, and it's like, why are you selling at the bottom? And again, it's one of the things where technical indicators can really take out a lot of that emotion, because if you're using things like RSIs and whatever, when the RSI is down at 30 or below on a lot of stocks and things, it's probably going to bounce. So you've missed your chance. You should have sold it when the RSI was up at 60, 70, not when it's down here. And I think that's the problem. It's like, and that's the fear thing where people just get so, they finally throw in the towel right at the bottom, you know, and you get that capitulation and the shares start rising again. So, but it's easy to do it. We all do it. You know,
so they say you teach best what you most need to learn, and you're talking to a lot of people and telling them how to do it. What advice have you got for us all from all of those conversations?
Wow, yeah. That's quite a hard one, really. I, in a way, I'd come back to my noise one. I think all of us need to be aware of noise and the fact that too much information, because that's one of the big problems I find with newbies, and I certainly had it myself, is someone said to me once, the investing world is like learning a new language. I was rubbish at languages, so that might explain a thing or two. But yeah, it is like that. It's like gobbledygook. You know, it's so different to what we know. It's like learning Chinese or something. It's just completely different. We're naturally voracious to sort of seek out more information. We read everything. We're reading every single stock and reading all this stuff. And you end up just jumbling your brain so much. And you get so many conflicting opinions that you can't ever make a decision about anything. And it's interesting that one of the commonest things I notice in new people is a lack of confidence in their own decisions. It's like they need me often just to buy a share. So they'll have been, so say for instance, Hostel World today. I bet there's loads of people who follow me who've been looking at Hostel World for weeks and weeks and weeks, and they think, oh, this is really good. I really like this share. I'm really tempted to buy it. I've got the cash. I just need, you know, I'm not quite there, but I'm going to buy it, but I'm not quite. And then they see I've bought it, and they're like, oh, Wheelie bought, oh, I'm going to buy it now. And sometimes it's just that confirmation bias thing that I think a lot of people, it's that reassurance thing. I've sort of been quite lucky, I think, that very early on in my investing, I sort of figured out that I actually could make my own decisions as to what to buy. Although I think one of the problems I was having, I think I bought too many tips in the old days. You know, you see tips in magazines and you'd be buying that. So in a way, I was getting my confirmation bias from tips. But luckily, I've got away from that, thank goodness. And I think it's so important to do that, of making your own decisions and cutting out the noise and striving for simplicity. Although striving for simplicity is perhaps something you can only do when you're quite experienced, when you've sort of learnt what really matters and what doesn't. You know, so I think that striving for simplicity is an important thing for us all to aim for, but I think we need to understand that it's quite hard to achieve.
And how do you build people's confidence? Because that's key.
I think a lot of it is just, you know, you spend time, people, you discuss various shares with them, whatever, and you just, you know, you get a nice portfolio. And what I tend to find happens is that once people have got a nice, diversified portfolio of quality stuff that's paying dividends and whatever, they tend to make money. And once they're making money, the confidence flows naturally. And I think that's a lot of it. You know, it's when you get someone who's sort of, you know, only been investing a couple of years, and yet already their portfolio is making 18% on the year, whatever, you know, they're like, yeah, I can do this. You know, it gives them that confidence. So, and I guess on the flip side, when you got someone who's struggling and the portfolio is down 30% and whatever, you know, when they have a conversation with someone like me, and I sort of say to, because I've, you know, quite often people email me their portfolios and I'll look through it and give a view as to what I think is good and what's bad and perhaps what they should do with them, you know. And obviously none of this is advice or anything, you know. Anyway, And so they look through the actual shares. We'll look for the shares, and I'll say, well, if you do this and this, and I think it's simply because someone's helping them, and saying sensible-ish things, they sort of get a good view that, okay, I've now got a strategy. I can see how I need to change. I think that's an important thing. It's like if you're losing, but you just keep doing the same things over and over again, you're just going to keep losing. It's the old banging your head against a wall thing. And it's a sign of insanity. If you lose the money, but then someone says to you, look, if you do this and do this and do this, you've got a chance that you might be able to turn things around. I think that gives people a lot of hope, and the confidence sort of comes as they see things improving, and as the changes start to take hold. I mean, I was just thinking one of the best things that people can do if they're finding it hard is buy Robbie Burns' book, Buy the Naked Trader. It's such an excellent book. And, that is a real going back to basics and showing you this is what you must do to be able to make money in shares. And it's mostly right. It's an excellent book.
It is an excellent book.
Yeah.
Pete, thanks very much indeed, both for today and also for everything you do for the investing community.